All right, our next guest says that the markets are even more sensitive than usual to Federal Reserve moves. Joining us right now is the founder and chairman of Tiger 21, Michael Sonnenfeldt. Good to see you, Michael. Thanks very much for joining us. Is the president right about the Federal Reserve?
You know, the Fed has an independence that it needs to pursue. It's concerned about inflation. And right now we have tariffs which are wreaking havoc. We're not sure to what extent, and an exploding deficit which would normally be rising with very low unemployment. Wage rising is starting to happen as well. So the Fed is taking its independent course, and we haven't had many presidents jawboning the Fed before. That's new territory.
Yeah, it sure is new territory. Now, look, we're all worried about growth. We're all talking about tariffs. We haven't actually seen the big international related companies say earnings are going to be down. We're waiting on that. The expectation is that we're going to see the impacts from tariffs, but we haven't heard it yet. Is that what you're expecting to hear in the next couple of weeks?
I think we're still in an interest rate story, and we've left a long period where capital was cheap, and we're entering a period where capital is expensive, and so you're going to have a sector shift. People who have competitive moats, like drug companies with intellectual property, content, they're going to be favored in this environment, recurring income. But if you're exposed to rising labor costs or tariff, you know, specialty steel is up 200%, 300%, 400%. Construction's going to take a hit. So we're going to have a real shift, and I think that's what this is beginning to presage.
Also the higher valuations, those companies that have really led the market, particularly this year, and you've seen that in recent days.
Yeah.
Combined yesterday, Netflix, Amazon, and Apple lost a collective $120 billion in market cap in just one day. But then if you look at how they've still performed this year, Netflix is still up 70% year to date, Amazon up 50%, Apple up 30%. So it's also not just the hardcore costs rising for businesses, but just the valuations that get whacked by higher interest rates.
They just got a little ahead of themselves.
A little? Or
look at the run
still up
they've been
70%.
on. Yeah, it's amazing.
What do you make of tech? Netflix, you mentioned subscription services. That's what Netflix is, and they're doing a lot of things to kind of keep that going. It did enter bear market territory recently, down 20% from its high, but it's still up 70% on the year-to-date. What are your members saying about?
So yesterday I was in a meeting with 12 members, and we're trying to put this together. A common theme is durable innovation, competitive moats. Whether Amazon is up or down today, it's still the only place you can put a shopping center on your desk. Facebook is the only place you can connect to 2 billion people. So they're going to have ups and downs because their pricing got a little ahead of themselves. But I wouldn't react to this market move right now. Our members are looking to the long term.
Yeah, no, I agree. The fundamentals are there, but the question is how much you're going to pay for that. How much you're going to pay for that fundamental.
Yeah, I think a lot of people are wondering how many companies and to what extent do they suffer with capital becoming more expensive? I don't know if you have a level where you say that's expensive now, but do you have a sense of how much of the market suddenly becomes unprofitable and looking not very competitive?
I think it's really about capital allocations. Our members built businesses from nothing, really. It's interesting. Today, you'd rather be a business seller than a business buyer. So a lot of our members are putting money in private equity to build businesses that they can sell. If I had to buy a business that was buying, they're going to be subject to overpriced acquisitions. If I had to buy a business that was going to be sold, that's a great opportunity now.
Let me ask you about a couple of these technical questions, because one item that Charles Brady here at Fox Business pointed out yesterday was that the sell-off is taking place on above-average trading activity. You saw but just at the close, the NYSE composite volume was 12% above the one-month average. So more volume on down days. Is that worrisome?
I think, look, volatility is up. I'm not sure if it's exactly related.
Yeah, I mean,
but
the volatility index was up 44% yesterday.
Yeah, it's back to where it was in February. So that's whether the market comes back immediately or not, we've clearly entered a period of higher volatility. You still want higher cash reserves. Our members are doing that. And they're taking chips off the table. In the fourth quarter, in the last quarter, our members took 10% of their real estate off the table, just we were talking about, because markets are frothy right now, and whether it's the impact of the taxes or the rising capital rates with interest rates, real estate is probably at a high for a while.